Welcome to TheoTrade. This is Don Kaufman here doing the weekend update for December 3rd, 2016. First, I'd like to start off by taking a look at a little bit of this past week of trade because there's some critical points want to be made about this past week. And then again, I like to be extremely forward-looking and really what we can expect in this, of course, coming week of trade where we very well could see in early December here quite a bout of volatility, and I'll explain why. So here we're going to start on this weekend update looking at the SPX, which had, albeit a very, very gradual decline this week right off of some of the all-time highs that were hit midweek. So in effect, one thing that I'm showing this on a chart, obviously, but I'm much more of a quantitative trader. And I want to start with this because the market right now is incredible at quantifying the moves. And allow me to explain what that really means. When I say the market's incredible at quantifying moves, let's not worry about broader markets for just a second. Let's focus purely on the SPX because the SPX is the S&P 500. It drives most of the marketplace out there. And what I'm talking about in terms of the market being able to quantify moves is, well, for example, this is an option that is going to expire on none other than December 5th, which if you look at a calendar, that's Monday. That's this coming Monday. So here I am on Saturday. On Monday, this option expires. And right now, we're projecting an expected move. Now remember, this expected move doesn't tell us which way we're going to go, but the expected move is projecting in the neighborhood of roughly plus, or minus a $20 move. And that is, again, that's about the expected move. So great. But my statement was that the market as a whole has been excellent at quantifying these moves. So let's close this up for a second and go back over to the chart. And if you look back, here's, Friday, Thursday, Wednesday, Tuesday, Monday, how much did we move this last week? So for that, we're going to go over here to the Analyze tab. And again, this is an extremely important point that needs to be made over here because in terms of quantifying moves, hey, everybody wants to know where we're going, right? Everybody wants to know where we're going. Well, the options market is telling you that. Well, again, allow me to explain. So what I've done right here, this is actually what they call Think Back. It's just one of the tools in thinkorswim. All it is end of day data. So at the end of each trading day, the servers on the thinkorswim platform take a snapshot of the data. Neither here nor there. There's lots of platforms that have this. But I'm going back right now to 1127. And you're like, well, what's the significance of 1127? All that is looking at is pretty much the close of the previous Friday, right? So the market closed at what? Roughly 22.13. And I'm putting it into the calculator. Now, the 5-day expected move. Now, this is looking back, right? This is, the 27th. It was looking ahead at the time 5 days, and the options 5 days out, they were projecting this entire week should see about plus or minus $23 of volatility. So let's go ahead and close this up. So just take this, all right, and you can go plus or minus $23. In this case, we know the market slid a little bit, so let's go minus, 23 equals 21.90. Okay. So what the SPX was projecting last Sunday was about a $23 move. That would take us to the downside to 21.90. Obviously, it could have also moved to the upside. So it's, 22.13 plus 23. Nevertheless, where did we end up? Where did we end up on the week? And the answer is, well, this was our answer. We were supposed to go to 21.90. Yeah, we went to 91.95. It is uncanny. Like, listen, this is a $2,200 product and it missed the expected move by less than 2 points. The options market has been dead on. You want to see how dead on the options market has been? I have another fun one for you. Here's 1127. Close up the 5-day options. Let's take a look at the 1-day options, right? There's a Monday expiration. And the Monday expiration says, well, we were supposed to move $10.30. Well, here we are on Sunday. Let's just go to Monday. There's Monday. How far did we actually move? $11.63. Again, this is uncanny how well the options market is projecting the moves. And it's because all the liquidity right now has shifted into S&P 500 products. Now, the reason I'm bringing this to your attention is because everybody right now is like, what's going on? What's going up? What's going down? We're going to come to that in a moment. But on a day-to-day, on a week-to-week basis, you need to be focusing on the 5-day expiration. Okay? The 7, all right, or, sorry, there's a 5-day expiration out there, but there's a 2-day expiration, which is a Monday expiration, a Wednesday expiration, a Friday expiration. There's 3 expirations per week now that are distinctly giving you an idea of risk in the marketplace. Now, I want you to be able to read into this risk. So again, forget about what you think. That doesn't matter anymore. It doesn't matter what you think about the market, because in the end, the markets are being driven by order flow, right? That and the bond market. I'll come to that in just a moment. But the order flow. And if you start looking at the volatilities, and you don't even have to be an options geek to get into this. But what do you see here? Well, there's almost a 13 vol. I don't even know what that means. And then it drops off a little bit to 12.8. And then it jumps up to like 13.36. The first thing I want to point out is this. Okay? Right? This is looking forward to this coming week. We ain't talking about last week anymore. Forget about last week. It's done. It's over with. Okay? We sold off a little bit. This next week on Monday, highly unusual. The expected move is almost $20. Why? Okay? Because all I've heard about in the news, the Italian referendum. Well, guess what? There's risk with the Italian referendum. That risk is being priced in. That's a $20 expected move. Now, if you don't look at these expected moves every week like I do, you wouldn't know that that expected move is roughly double what it typically is. What's a typical week look like? Guess what? I can show you. Go back last week. The 1-day expiration, typically on a Monday, has about a $10 expected move. That's a typical one. Lately, the volatility has been really low, about a $10 expected move for all of Monday. Right now, though, we're facing this coming Monday, a $20 expected move. That means put your helmet on come Sunday afternoon when the futures open. They're expecting markets to be rocking a little bit. Then as the week progresses, well, the risk kind of dives off a little bit on Wednesday. But then again, here's the Friday expiration, and the risk is actually going to jump a little bit again. Why? I happen to know because I looked at it, but there's an ECB announcement, the European Central Bank. So Mr. Mario Draghi is going to come out and talk. But it's an interesting ECB announcement. Why? Because it's after the Italian referendum. It could actually change what the ECB thinks. Mario Draghi, better known around here at TheoTrade as Ivan Drago. Yeah, I don't know how I relate that to Rocky IV, but it works for me. All right, so understand that early this week, we are expecting substantially more risk than we have seen as of late. Okay, how much more? Well, again, compared to last Monday, almost double the risk. Okay, let's go look at the markets though now a little bit. What happened? So here's the SPX. Comes off a little bit. More importantly, let's go take a look. All right, you can look at the IWM, you can look at the Russell, the same animal over here. Also, highly volatile product has come off. All right, last but definitely not least, the Qs. The Qs have totally bucked the trend. And what we're still not seeing in the marketplace this past week, we're not seeing correlation. All right, and if you're not familiar with that term, it's something I've talked quite a bit about on these videos, but I don't know if everybody tunes in every video, but let me talk briefly about the correlation coefficients in here. So we're looking at the product, the Qs, right? And this is a 9-month chart on the Qs. But what I'm going to do is I'm going to come down to style, load up the style. This is the Q, okay, with the spiders, with the IWM. What does it mean? It means volatility. Let me actually point out each and every one of the products over here. Again, this is a 9-month. Up on top over here, that's the IWM. That's the Russell. Okay, what's the little monkey right in the middle over here? That's the Qs. And last but definitely not least is the spiders. So that's performance. I apologize, over the last 6 months. Over the last 6 months, this is performance versus one another. One of the things that I often look at, okay, in a comparison chart. Now, in comparison charts, they're not perfect. And I'm going to show you why comparison charts are not perfect. If you ever look at a comparison chart, you need to look at multiple time frames. Okay? Looking at one time frame doesn't do it, because point A, which is the very first data point, when I say point A, okay, what I'm specifically saying is the very first data point on the screen is where the comparison begins. So everything starts from, point A. Now, if you change the time frame, things are going to look drastically different. Let's go out to 3 years. On 3 years, you're going to see that the product that was performing, again, let me do camera 1, camera 2. This is the IWM. It's the outperformer, right? On 3 years, it's the underperformer. The most important lesson to be learned from here, the products are converging upon one another in a fashion so fast and so furious, okay? In any historical event involving volatility, products were converging upon one another prior to that volatility. Just because markets are near all-time highs, again, you cannot get off your game right now. All right? I've heard all the excuses, well, this is going on and that's going on, and economically we're looking okay. It does not matter. At this point, just the convergence of these products is enough, okay, to keep me on edge on a day-to-day basis. And again, no matter what time frame, you can look on a 10-year. You can actually visually see, and over 10 years, these products, okay, are making vast moves in a very, very short amount of time, okay, converging upon one another. By the way, up top over here, that's the Qs. You just see like, what has the NASDAQ done, okay, versus the other products, which brings up my next point. That's this. In the next week or two, you might be really tempted, okay, and I turned on mainstream media the other day. I don't do it often. And I actually didn't even turn it on here in my house. It was on. I was out working out. CNBC was on. Okay. They had the volume on. I didn't have my headset with me. And they were talking about, well, should you buy tech? Plain and simple. This is not a time for bottom fishing tech. Did you not just look at that 10-year chart versus the other index products? Okay. If you want to try to get long technology, I don't care whether it's Apple, I don't care whether it's Facebook, they all have the exact same chart, whether it's Amazon. Okay, individual charts do not matter right now. Nobody cares about individual products, right? We're in a marketplace that's highly bifurcated. What that basically means, they're killing tech and they're buying stuff like what? Like Caterpillar. And for the record, I'm actually short Caterpillar because I think it's going to be a good short opportunity here. This is going to be a duration short, though. Means you're going to have to hold the position. Nevertheless, back to the Apples, the Googles. I don't care what you're looking at on the chart. If you want to get long a Google right now, you got to do it with a spread. Plain and simple. You go out there, okay, you pick your entry point. When I say a spread, if you want to buy it, go ahead. But use some like really small spread, some $2.50 wide spread, or, go out there and at the most, maybe buy some kind of like $5 wide spread. Anything to mitigate your risk. You go out and you sell naked puts in a Google, or you sell naked puts, or you go out and buy physical stock of Facebook or Apple right now, and you're going to get what you paid for. Okay. The bottom line is, I don't know what the future holds in Facebook. Nor do I know what it holds in Apple or Google or Amazon, and neither does anybody else. All right? Plain and simple. Again, we're seeing a convergence in index products. Volatility is all over the place. And when I'm talking about volatility, I'm not talking about the VIX. Okay? Interest rates are skyrocketing right now. Come to that in just a moment. You step in way of a freight train, and you're going to get your head taken off by that. So looking at something like Facebook, there's only one argument to make of a product like this. Yes, you can get long, but you got to do it with defined risk. Because in the end, even if you're right and this product goes up, the upside potential is just not worth the downside and possibly catastrophic risk. And that's what people have to realize. Like they're talking about, it's a tech mess out there. Really? The thing has gone from like what? 130 down to 115. You're calling it a tech mess on a percentage basis? Come on. Let's go look at it. There's a percentage basis. This is on a 3-year daily. It's barely come off. I mean, hey, here it was on a percentage basis. Well, it's had a 178% incline over the last 3 years. Oh, but it's given back a little bit of that. Yeah, it's given back a little bit of 178%. You want to get really crazy? Why not you go look at Amazon right now? Okay? That's kind of taken off to the upside a little bit, but it has come in. This isn't a tech wreck. All right? This could be, again, just shaving the tip of the iceberg out there. Now, another news, you better look at the financials, because the financials, they're completely and utterly parabolic. Okay? At this point in time, all that's driving the financials has everything to do with the bonds. Okay? The financials are being driven by the bonds. It's just as parabolic, watch, just as parabolic as financials were to the upside, the bonds are to the downside. It's an arbitrage, plain and simple. That is, ZB sells off, financials take off to the upside. Okay? But this marketplace in the ZB, it is dicey. And what I want to focus on once again is interest rates here. So the interest rate has ripped from, and let's just look back now, pretty much since the presidential election. This is when the 10-year interest rate, this is a 10-year Treasury index. It's the TNX, okay? And the TNX just a few weeks ago is trading 1.8%. That, again, I know it says 18, but it's 1.8%. 1.8% skyrockets to almost 2.5%. All right? I don't care who you are. You better be thinking right now, which one of the asset bubbles pops first? When I say asset bubbles, we all knew that bonds were going to be a bubble and eventually the interest rates would go skyrocketing. But as the interest rates go skyrocketing, what other is the asset bubble? Need I go back to the NASDAQ? You're going to find out really quick. If this interest rate still goes up, you're going to find out really quick if the NASDAQ happened to be a bubble. What I'm getting at with the interest rates is the interest rates will slam the brakes on the economy. If the interest rates continue to go up, anything above 2.5%, I mean, we're pretty much there, but anything above 2.5% becomes really, really dicey for the entire S&P, and I'll tell you why. Once the interest rate starts getting above 2.5%, okay, it makes sense for a lot of people to go out and buy a 10-year bond. Why? Because they're going to yield 2.5%, and they don't have to basically deal with Apple anymore that's only paying 2%. It's not that Apple's a deal. Yeah, but it also could be a declining company. They don't know. They don't have to deal with Amazon that doesn't even pay a dividend. Capital could come pouring back into the bond market, out of the equity market, because all of a sudden the interest rate becomes, well, appetizing again. Now, again, that's part of it, but there's also the fact of the matter is stocks may not do stock buybacks anymore because the interest rates have increased. Doesn't make it worthwhile doing the bond offering to cover the stock buyback. I can give you 50 different reasons that once those interest rates start to jump, it doesn't become a happy place for markets anymore. The bond market at this point rules the day. And the bond market is as unpredictable as it has ever been. And I want you to have that unpredictable feeling. All right? You need to have, in this marketplace right now, an unsettled feeling. Sure, there's a new president coming in, all right, change of administration. The only thing you should be worrying about right now, okay, is your portfolio. Are you long? Are you short? Right? Are you happy with your positions out there? If you feel you have too much risk in one area, clip it back. This isn't the time for heroes, okay? This is a major decline in the bond market. Equities, they haven't felt the fear yet. They're not feeling anything yet. This is the marketplace, though, that stands right now. Okay? The single largest risk is going to be in the broader equity markets. They haven't felt the pain of bonds, okay? You're seeing your dollar is exploding, all right, higher. You've got commodities all over the place. You've got bonds all over the place. The equity market feels kind of stalled out. Don't worry. I think it's coming this week. I think we're going to see some wild volatility. And I'm not ready to call like, oh, we going up, we going down over here. Hey, I let my positions speak for themselves. I carry substantial bearish positions, and I always make that known. But I also believe in duration over direction. That is, I'm going to be bearish. Maybe we hit another all-time high this week, but that's okay. I'm still going to be bearish out there. And it's not just because, hey, Don feels the need to be bearish. No. It's all a matter of risk reward. And do I feel that there's upside potential in the marketplace? Of course I do. It's foolish not to think that the market cannot make that upside move. Ain't no Fibonacci, no Bollinger Band, no stochastic, not even Elliott Wave is going to tell you where this market's going to go. It's pretty much in the bond's hands. It's in the hands of an Italian referendum, okay, that could play out very, very poorly, or it could play out extremely well, but then we don't know what Mario Draghi is going to do. Do you know how many elements are involved in this? Thousands of different variables that are all going to play out in the S&Ps this week. Nevertheless, I just feel the risk is far too high to want to buy a market near all-time highs. And I'd rather sit, be short. I'll wait for it to come in. Okay, mark my words, it will come in. Even if we hit all-time highs this week, we're going to come in. Stay tuned for it. Again, watch your risk on the downside over here, especially in products like financials that have just had stellar moves to the upside. So one of the things that we saw this week, and I want you to be thinking about, we had a day where the bonds sold off and financials started selling off. Finally started to break the financials because interest rates went up too quickly. Think about it. Thanks everybody for joining us here at TheoTrade. I'll be back on TheoTrade chat all throughout the course of this week. Have a great weekend, everybody. Bye-bye.